When we talk about your prime when it comes to your finances, we are referring to your 30s. Your 30s are the decade that decides everything. They are your foundation decade. What you do now or what you build now in your 30s will determine what you live inside of for the next 30 years. So if you are in your 20s listening to this video, great, you have a head start. If you are in your 30s, this video will give you some of those money truths that nobody tells you in your 30s. And if you are in your 40s and 50s, this is an opportunity for you to reflect and self-correct when necessary. But before we continue, if you are new here, welcome to our beta version. My name is Elizabeth, but you can also call me Les. And on this channel, I talk about personal finances as well as wholesome living. And please do note that nothing I say on this channel should be seen or received as financial advice. And if you are looking for financial advice, please speak to somebody who is certified and registered with the relevant bodies in your area in order for them to provide financial advice. And if you have not yet subscribed, do hit the subscribe button. Let's build a community of people who are actually building wealth and not just talking about it. So here is what nobody tells you about money in your 30s. The first thing is that your income is not your wealth. And I say that because I know people who are earning 80K a month, who are just one salary away from a crisis. And I also know people who are earning 25,000 or less, who are building something unshakable. And you know what the difference between the two is? One has a lifestyle and one has a system. One of the biggest traps when it comes to your 30s is lifestyle inflation. It's the bigger car, it's the better apartment, and it's the nicer holiday, and it keeps going and going. For a lot of people in their 30s, their standard of living keeps going up while their net worth actually stays flat or it goes down. So what can you do? When it comes to your 30s, your top priority is to increase your income. That should be your number one goal when it comes to your 30s. Because once you have a higher income or you are earning more, you are also able then to save more and to invest more. And the idea here is for you to keep creating a wider gap between your income and your expenses. So basically, you want to earn more and you want to keep more of what you are earning, and you want to channel that towards your savings and your investments. The second truth about money in your 30s is that debt is very expensive, especially high interest debt. We have normalized debt so much, and that is because debt has become so accessible. You just click a few buttons on an app or on a website, and there you have it. You have access to debt. We have normalized car payments for cars that we can barely afford. We have normalized personal loans to go on holiday with our friends. We have also normalized maxed out credit cards on online shopping and takeaways. We have normalized buy now, pay later so that we can look rich at the office. And the last one, which is one of the ones that I really dislike, we have also normalized revolving credit facilities for just in case. And this may look normal to some people, but it's not. Consumer debt in Southern Africa carries interest rates between 18 and 28%. And that is not a small percentage. And it gets worse. When you look at your cash loans or your loan sharks where you also go and get money, their interest rates are between 30 and 40%. That is even more. So basically, we are paying too much money to carry this type of debt. And guess what? It's almost impossible for you to find an investment that will consistently give you over 20% in annual returns. It's almost impossible. So that basically means that paying off your high interest debt right now is one of the best return on investment that you can do for yourself. It's one of the best decisions that you can actually do for yourself, paying off all your high interest debt. And here is what you can do. When it comes to debt, you need to make that decision that I want to get rid of this debt. And once you make the decision, then you need to decide which method are you going to use to pay off your debt. If you are somebody who wants to save money on interest, you go with the avalanche method. If you are somebody who needs momentum and motivation, then you can look into the snowball method. The method that you pick doesn't matter. What matters is that you have made a decision and you have chosen a method and you go hard on tackling that debt. And when it comes to the order of priority, when you are paying off your debt, your top priority should be paying off your high interest debt first. And once all your high interest debt is gone, then you can tackle your car debt. Once your car debt is also gone, then you can now tackle the big madala, which is now your home loan, if you have a home loan. So basically, high interest debt first must be gone. After that, you tackle the car. Once that is also gone, then you can tackle your home. And this works out well for people who wants to pay off their house in 7 years or 10 years or whatever number of years, and who are always complaining that why is the bank not allowing us to pay off our houses in 5 years. You can. You just need to pay much more extra and be more intentional when it comes to tackling your home loan. There is nothing that is preventing you from finishing off your house in 5 years, 7 years, 10 years, or 15 years. You don't always have to do the 20 years. Most people do 20 years because somewhere along the way, they give up on that loan because they feel they have so many years, they can relax and take their time. But if that is not you, you can actually tackle it faster and you finish in a less number of years, and obviously you save so much money on interest. The third truth is that emergency funds are not optional. When it comes to your 30s, having an emergency fund is not an option. It's a must. You must have an emergency fund. Because if you don't have an emergency fund, it means you are going to get into debt. And not only that, you are going to take out high interest debt. The second thing that will happen if you don't have an emergency fund, you are going to pull money out of investments. And as a long-term investor, that is not something that I want to hear about. You want to remain invested. The third thing that is going to happen is that you are going to move backwards financially. You know, when they talk about taking 3 steps forward and then 5 steps back, when you constantly do not have an emergency fund and you keep using money which is meant for your other financial goals, you are moving backwards. You are not moving forward. And the one that people don't always talk about, when you do not have an emergency fund and you are constantly borrowing and asking for money, you are going to ruin your relationships. It's your relationship with your family, it's your relationships with your friends, and it's your relationship with your partner. People love you, people want to support you, but they cannot be your emergency fund. And you know what? When it comes to emergency funds, having an emergency fund is what separates those who are financially stressed from those who are financially stable. Be the stable one. Don't be the person who does not have stability, who is constantly stressed because they have not made provision and they constantly have to borrow and ask for money. Be a stable person. So what can you do? When it comes to emergency fund, you want to put aside 3 to 6 months of your living expenses. Not your income, your living expenses. And this is money that you put away in an account which is separate from your usual account. And that account should be accessible. It should give you interest. And it should be an account that you are not constantly touching. So 3 things are key when it comes to your emergency fund: an account you do not touch, an account that gives you interest, and an account that is accessible. Don't go take out an account where you need to give a notice of 30 days because your emergencies will not wait for 30 days. So you have to be realistic. So you want your money to be accessible and for you to solve your financial problems as soon as possible. So be a stable person and have an emergency fund. The first truth about money in your 30s that nobody tells you is that your biggest risk in your 30s is not the stock market. It is yourself. You are the one who constantly sabotage yourself from progress. And I say that because you are the one who makes impulse decisions and make impulse purchases. You are the one who chooses a good lifestyle right now instead of building a future for yourself. You are the one who borrows people money without a plan, be it your friends, be it your family, and most of the time, you never get that money back. You are the one who draws money from your emergency fund to do things that are not an emergency. And when an emergency comes, that money is no longer there to cover you. And you are also the same person who avoids important money conversations. Whether it's money conversations with your partner, it's money conversations with your friends, it's money conversations with your family, all those conversations are important. Our lives are run by using money. And if we are not open to speaking about money with our loved ones, we are bound to either be losing out or to be leeching on other people. And that again brings rifts in your relationships. And if we are being honest, a lot of 30-year-olds are navigating the complexities of their 30s with a mindset of a 20-year-old. 20-year-olds are carefree and they are living for the moment. They are not thinking about tomorrow, they are not thinking about 10 years from now. But as a 30-year-old, this is the best time for you to build wealth. Your 30s are your prime years when it comes to your finances. So you want to navigate your 30s with a mindset of a 30-year-old who is not only thinking about today, but they are also thinking about 10, 20, 30 years from now. So what can you do? Invest in your financial education. Financial education is very important in our lives, especially if you are in your 30s. Read more, listen more, ask better questions. You know yourself better. You know how best you learn. If you are a podcast person, listen to as many podcasts on money as possible. If you are a book person, read as much as possible. If you love YouTube and you love videos like this one, listen to as many YouTube videos as possible and ask better questions. And I'm one of those people who are always asking so that I learn better. Always ask. There is nothing wrong in asking. Get clarity. It doesn't matter who you are talking to or who you are asking. Ask better questions about things. And the most important one, build a money system. In this day and age, at the adult level of the 30s that you are, build a money system. That is one of the best things that you can actually do for yourself, and your future self is going to thank you for it. And truth number 5 is that time in the market beats timing the market. It's not about when do you get in. It's about you getting in and staying in the market for as long as possible. A lot of people have a tendency of wanting to wait for the better time, for more money, for things to cool down, for the market to correct, but that is not your job to worry about. You are not a trader, you are an investor. And as a long-term investor, you are not worried about the small movements that are happening right now. You are worried about the 20, 30 years from now. So just get started, start small. Start with what you have, but start right now and build the habit. The habit is the most important thing. Get into the market and stay in the market. So let's bring all of this together. From the 5 money truths that I spoke about, your income is not your wealth. Debt is very expensive, especially high interest debt. Emergency funds are not optional. Do not try to time the market. Rather, stay in the market and start investing today. The sooner that you start, the better. And if we are being honest, for most people, when it comes to financial freedom and building their wealth, the biggest challenge is not the math, it's not the numbers. The biggest challenge for most people is behavior. You need to constantly build habits that are meant for you to build wealth. Habits that helps you to put systems in place and for you to take the right actions so that you are able to build wealth. Building wealth is boring, like I always say in my videos, and it requires a lot of boring, repetitive habits, actions, and systems that you need to have in place. That is the only way that you are going to build wealth. So as somebody in your 30s, or maybe you are in your 20s, or maybe 40s and 50s, the best time to start was yesterday, but the next best time is right now. Don't wait, start today. Start with what you have, start where you are. Don't wait for the perfect moment. Don't wait for the perfect time. And that is all for today. Let me know in the comments, how are you navigating your 30s? And if you are already above 30, maybe you are in your 40s or 50s, also tell us what has worked for you. I'm sure we can learn a lot from you. Otherwise, I'll see you in the next video.